Here you can see a trading student result who made with $100, $840, and then he made another trade with using $100, he made $810. And I'm going to show you how he's reading the candles and how you can use it for your trading. First of all, it is very important to understand that every pattern you see you're reading books, even in these videos, only is working when you have built a relationship to the market. That means you want to make sure that you have this one single market. We use, for example, the S&P 500 futures it's called, or you type in US 500 as you can see here on the top left side. And then using the 1 minute chart, you don't need any indicators for this at all in the beginning. And this is something what will extremely improve your trading if you take a calendar and you have specific trading times. From 9 a.m. in the bottom right side, it says UTC +2, but here when being on TradingView, you can select here on the bottom right side, here's Chicago time, Central Time. From 9 a.m. Central Time to 3 p.m. Central Time, the market is going to aim for bigger structure, highs and lows. So anywhere there in between 1 or 2 or maximum 3 hours is totally fine. You can see here how he took your notes, that he wanted to trade here 4 or 3 hours here, you can see here. And then what he is concentrating on is when making the chart very small, so tiny as possible like this. Now you can see that the market is moving upwards and does more green than red candles. If you have something to write, then use this as a reference. Using this 3-step method that we always use for our trading is step number 1. The market on its session time always wants to go to bigger structure highs or bigger structure lows. And when you see that the market is more near at the high than the low, like the upper part, the upper line than the bottom line, then it makes very much more sense that the market wants to go up there, right? So and this was the major reason why he was trading up. Now, how was he able to use $100 to get $800 a trade? And this is called leverage and, of course, reading the candles very well. Leverage means if I have a $1,000 or $3,000 account divided into 10 or 20 trades, right? I just wanted for my, let's just take an example. Let's take a $3,000 account divided into 3 times, because I think it's not good to use just like within 10 trades and then the account will be blown. And then we take the $1,000, we divide this into 10 trades. Now we have $100 a trade. A fixed rule set is when I'm using $100 to take always $500 for each winning trade. We're going through that. So with the candles, with the $100 to adjust, I need also to add, it depends on the broker you have. I love to use an American broker. On the American, that is near the American exchange, so it's cheaper in commissions to trade, and it gives also way more leverage. I could adjust $100 a trade by just having $400 of margin, it's called. That means I only need $100, like I need $400 on the trading account, and $1,000 or the $3,000 would be better, and I could use already $100 a trade in average. So this is about leverage, and now we're going about the candles. When the market starts to make more than 3 green candles, this is something what is very important. Only if you can see by looking at the market multiple times. Most trading students of mine, they are looking at the market for 15 or up to 30 trading days without taking a single trade. And all they do, and this is something what will make you a better trader, is making the chart small, looking for the very biggest structured high, the point where the market came from, or the very biggest structured low, using the same market, trading on the same time. Here you can see the trader was here online from here to there, and here online from here to there. But one session time, 1 or 3 hours is totally enough for you. And then by looking, does it make more sense the market goes up here or that the market wants to go down here? And here's the thing. Once you are able to see that, and this will take you weeks, minimum 3 weeks, 4 weeks, 5 weeks. If you're already a trader, if you are somebody who never did anything else with trading, just go to my webpage, tradewithjd.com/training. You find a free training there. I hope it will make you a better trader there. It's a step-by-step guide. And if you have experience already over 2 months, 3 months trading, looking already at some markets, this you should already see on certain days how the market goes up or goes down. A very big problem is just that a lot of traders, they try to trade every day, and I think this is not good because the market is not even every week going in one direction. You have sometimes a whole week where the market is just wiggling around, dizzle dazzle in a contraction phase, we call it. And I think it's way more better to wait until we can see the market goes up or down, and then we take opportunity of the market. So once we can see that the market structures up and wants to reach a bigger structure, higher low, this is step number 1. We go to step number 2. And this is something what's very important. That is, we concentrate that the market starts to make more green than red candles. More green if the market goes up, more red if the market goes down. We concentrate that the market is shifting up like this, as I'm drawing here inside. Something what is very important, that you can see it shifting up. So when you see more green than red candles, when you see the market shifts up, as you see here, upper side and bottom side, you just want to see it dazzles up, just like that. This is already a good sign. And then we concentrate on the retracements, what the market does. A retracement means that if you see the market goes up, I'm going to draw you here an example, and this is something very interesting, that when you see the market goes up, a retracement means when it comes back that it continues its movement. But a retracement is only a retracement when it happened already. So when you enter down here a trade and you buy and it goes down, it was not a retracement, even though you have a green candle. They will say like in a smaller microstructure, it was a retracement, but it didn't happen. So instead, what I really love is to wait until the market does same lengths of retracements like that. And then when the market does here in this area, just a green candle, this is step number 3. I love to enter the trade because we estimated the market wants to go to a bigger structure. Step number 1. Step number 2, the market is wiggling up and does more green than red candles. And then step number 3 is just any small, and this is very important. Sometimes we have this very big green candle, and this is the risk reward ratio killer. We need to have a very small green candle that the market wants to go even up. So here you can see, and this is something what's important. Actually, everything what I mentioned is important. You can see from here to there, this is how big the contraction phase was. Now check this out. If I'm taking this square within the length, you see here, it has the same length here. That makes when we see this retracement that the market comes back, does a lot of green candles, and it comes back again. That means not just entering here within a green candle. When the market does here somewhere a green candle, taking this in consideration, adjusting $100, losing $100, totally fine. When the market, and this is something what's important here, when the market starts here to make a green candle, you see it's very near already to this reference. And you see like there's pressure gone, but these green candles can be fine. That would be the 3rd trade. And then you see here the next time the market does a movement back and just a green candle is either here or either there. And here you see it again. And it's about that you look at it so often as possible. And taking any of these when the market does the same length back because you saw it. Taking these trades. And in the worst case, here you can see a small candle. This one would be too long. In the worst case, when losing here $100 for one trade, when losing here $100 for one trade, when losing here $100 for one trade, and losing here, in case, I don't know, but actually this one worked. Here one, it was like $500, but let's just assume this one would be also minus $100. We lost here $400. But here's the thing, and this is the difference between the one thing is market experience, what a trader has, and the other one is the trading strategy itself. The strategy differs between the other person who uses the trading strategy. Both are making the $1,000 move, but is the one guy losing only $50 or $100, and the other guy losing more than $1,000 by taking the $1,000. You can see here that this trade here, when entering the trade and adjusting here $100, that this is an $800 move. And now check this out. The market comes back and you see how this move back here, this retracement, we also do this with bigger retracements. This retracement here had the same length as this retracement here, as you see here. So any green candle down here will do, and he took the green candle and made another $800 here. And I'm going to show you now how you can see it on the market, these 3 steps. So step number 1, bigger structure, highs and lows. You can see it goes there to the session time, trading 1, 2, or 3 hours. Step number 2, a lot of green candles, or a lot of red candles, and wiggling in that direction, up or down. And then also measuring the length of retracement, what we're going through now after explaining you the 3 steps. And the 3rd step is just any green candle will do, any red candle We enter the trade when the green candle closes. On the right side, you have mostly, or on your trading platform, a countdown. It will count down from 1 minute. It will tell you when it closes. We enter where the green candle closes at the top. The red candle closes on the bottom. And then the stop placement at the same candle that we used as a reference for tight stop placement. And it's okay, we will have many losing trades. And it's totally fine. If we have 7 losing trades of $100, that's $700 of loss. But if you have 2 trades that are working with $500 to $800, we will eventually make money. And this is something that's very important. That's why not just 10 trades divided by the whole trading account. We're talking about the whole trading account divided into 30 trades, for example, or like 20 trades minimum, just to sustain it very well. So now how can you see it? And I'm telling you, quantity beats luck. And the more higher informations you got, the faster, high quality decisions you can make. If you have something to write down, write this down. So we have here the rectangle using TradingView on the left side here, making a star here. And in the practical side, it is to make the chart so small as possible for our peripheral vision, it's called, that we can see the rotations. And now when you want to measure here the retracement, then you want to use the rectangle and just place it here. And you see here the same retracement. You want to see here, for example, that the market, that it makes more sense where it structures up. Like here, it makes more sense that it structures up. Of course, it should be the US market to the US session time, please. That it makes more sense, for example, like US market means like central time here. Central time, 9 a.m. to 3 p.m. I think is the best. 8:30 it opens, but I think it's too dangerous. And you can see how it structures down. Now, when you have here the biggest structure low that is here, measuring the retracements, you need to do this many times, and yes, it takes effort with the mouse. There are indicators that are making it easier, but I found out after 7 years of teaching people how to trade, it is not good. We always use better the mouse, that the market does this length of retracement, or check this out. And then once the market does the same move back in just a red candle, you can see how the market goes down. And the better you can see that the market goes down, the better it will work. And what I'm really giving you as an advice is make always a picture in the beginning, how you saw the market in the first impression. Make a picture always in the end. And then make the chart always small like that you build a relationship more to the market. The more stronger your relationship is to the market. That means if a trader would learn, for example, with me, that has trading experience already for 3 years, gets after 1 month better results after somebody who has never ever traded after 4 months. He needs minimum 4 months or 7 months, because the thing is, he never was making the chart small like that. Never looked like, did the market go down here or up here? He was more concentrating maybe on smaller structures, indicators, or other things. Hope you could take something out of this video. Wish you all love, good trades. JT out.